All right, not long ago, Central Bank of Nigeria's Monetary Policy Committee raised interest rates by another 50 basis points to 26.75% at the conclusion of the 296th MPC meeting of the Apex Bank. There are the details, 50 basis points to 26.75. The adjusted asymmetric corridor is now plus 500 minus 100 around the MPR. The cash reserve ratio, that's CRR, unchanged, 45% for DMBs, which is deposit money banks. Also unchanged for merchant banks, 14%. Liquidity ratio held at 30%. As always, we've got a couple guests in the studio to discuss what this all means. Victoria Njimanze is the senior fund analyst at Afrinvest Asset Management. And also we have Clair, Ojemen, who's a research analyst at FBNQuest Asset Management. Good afternoon to you both. Good afternoon. Thank you for making time to join us. Victoria, let me start with you. I guess the same questions for the both of you. We'll just go round robin. This was in your estimate? Was this in your forecasts? What did you make of the decision?
Yes, thank you very much for having me here. Yes, our decision, we actually perceived that they were going to hike rate by between 50 to 100 bips, and that's largely on the body language that Governor Cardos already sent to the market sometime last week. But we thought they might probably be holding, to just assess how all of the hikes have really permeated into the system, right? But even though they did hike, I'm of the opinion that we still need to reassess how all of this has really affected the system. Inflation in itself has not reduced anyways, from 11% when we started the hike 2 years now, and now we are 26.75%. It's not like anything is really changing. So I think it's time for us to reassess all of what we are doing and see how it is effectively, affecting the economy.
Before Claire, I'm going to come to you, of course, but just, that dynamic that you just talked about, I was watching Bismarck Rwani and Esili Aigbe, both of which are guests, prior guests on the station. And Bismarck Rwani was saying, nope, they got to hold. There's no point in hiking. And Esili Aigbe was like, nope, they have to hike. And it was just lovely watching the both of them go back and forth, standing. So, Claire, what do you, is this your estimate as well,
yes,
or your forecast?
We had also expected that the MPC will increase the MPR rate. We're also looking at 50 basis points to 100 basis points, and our expectation was due to, the inflationary pressures we have seen, since the start of the year, as Victoria, mentioned. Then aside that, trying to also, bring in FPS into the economy and also to, stabilize, the effect volatility that we have seen so far since the start of the year. So it was expected.
All right. So, the man, woman on the streets will say you fancy analysts with your analyst notes and your MPRs and CRRs and so on and all your fancy terminologies. What does this mean for me? What does this mean for me, my family, my business? Victoria, what does this mean for the average person?
All right. So this surely worsens the status quo, right? And I will try to put it in perspective. So now we have MPR sitting pretty at 26.75. And let's look at it from the bank angle. You mentioned asymmetric corridor plus 500 minus 100. So that means effectively, if a bank is going to borrow from the CBN, that's plus 500. Okay. So that means 31.75. Now, if I am a bank and you are coming to borrow from your real sector, what rate am I going to be lending to you?
Right.
Now, that's one side. I borrowed from the bank now, and I want to make these goods. I've made these goods, and it's an inelastic demand for my product. So that means even if the prices are going high, you have no choice. You have to buy it. Right. Now you are buying it, and I have to pass that cost somehow, right, to somebody. So prices go up. At the end of the day, it's just like a cycle. Right. Prices go up, inflation.
Around and around and around we go. Claire, you agree? What do you think?
So also add to what Victoria said, higher borrowing costs, higher debt levels. Then in addition to that, that might all be negative. But if we look at the positive side, it just increases the propensity to save, by Nigerians, because with higher MPL, it fits into the fixed income market, yield repricing. So it gives Nigerians opportunity to come into the fixed income market and a bit to take advantage of the higher interest that they may get from the fixed income market.
Okay, well, yes. you've preempted my next question. But that's fixed income. What about equity? So for the investor, how does the investor see all this?
Exactly. So I'm going to pick it up from where she
I love how the two of you are bouncing off each other. Fantastic.
And I really think it's more one-sided, right? And why I say this is that is for a new investor.
Right.
We already have investors that are in the market. It is not good for them.
Okay.
Right? So it's a two-edged sword when you're looking at it from the investor perspective.
Yes.
If I am new in the market, it's good for me. I'm getting better rates, especially for fixed income. It doesn't really affect the equities market, right?
Yeah.
I remember first quarter of the year, equities was like the king, right?
Right.
40%, everybody really wanted to get 40%. And now, even yesterday, it's no longer as high as it used to be. So everybody is dealing with it one way or the other. So yes, it's good for the new investor coming to the market, right? But people that are already in the market, they still have to deal with it.
Yes, just to also add, I mean, she's mentioned new investors. I mean, tomorrow we'll be having the auction. So we will likely see, even though it's just 50 basis points, we might see a little bit of, improvement of yield, and investors also, bidding at higher rates. I mean, we are coming at, yesterday we had the bond auction. We saw stop rates increasing across the three instruments at the auction. Then, I mean, this month we also saw that the inflation for June also came in. So we'll be expecting in new investors, existing investors, pricing all this into the auction tomorrow. Then also for the equities market, not just for investors. I mean, look at equities players, FMCGs. They are currently being impacted by inflation, FX, volatility. This just adds more to cost of production. We also will affect their bottom line by the end of the year.
Glad you both mentioned inflation. So we want to play a clip, in fact, two clips. We had a guest on the show earlier this morning in the beauty segment, funny enough, and she was talking about, I think it was particularly FX currency devaluation, how it's impacted the industry. And then I want to play what Cardos said, because he was posed the question about inflation. So let's take those back to back if we can.
Honest, more than all times, this is actually the first time that I have seen the Naira devaluation this bad. And for this industry where we pride ourselves in giving our clients the absolute best, we sell confidence. We want people to look good and stay good, because when you look good and, feel good, you're able to operate at your highest, frequency. But the Naira devaluation and inflation has really impacted this industry negatively. So, for instance, as you said, the equipment. So we are a US-founded medical spa, and everything we do is highly regulated by the FDA. So that means that all our product, equipment, everything we do, training is all from the US. We're just based in Nigeria, but everything we do is based off, the US policies and standards. So for me personally, that has been a huge challenge. And I can imagine other, genuine aesthetic practices out there, what they have to face. The cost of labor has gone up for sure, even just locally, because now to get the best talents, the salaries have to increase, right? You have to get them, you can't just get them at a lower cost. It has to be very high. The cost of even bringing this equipment in is extremely high. The cost of having to change Naira to dollars is extremely high to be able to get this equipment in the country. So everything has gone up. And of course, because of the, inflation, that has really affected our consumer spending habits.
My belief is that it is so fundamental to the long-term future and stability of our economy that inflation should be brought under control. That in the short term, these are pains which ultimately will be able to help our economy and help the manufacturing businesses as well. However, it's also important to reflect on how we got to where we are. Okay, and let's not forget that this was largely as a result of a tremendous amount of liquidity that came into the system in a relatively short space of time. Okay, when you print money on ways and means, it has its consequences, and we are paying for those consequences right now.
All right, so we could have an entire segment just on those two clips, but I love the putting a private sector player reacting to inflation, and then the public sector side, the monetary policy authorities both reacting to the same thing. So I guess I just want to get both your reactions to that, and I guess how this fight against inflation is panning out. Victoria, I guess you first with what you've heard.
Okay, so like you rightly said, right? Inflation has been going up, everybody is aware, but I think there has to be a synergy between both the monetary and the fiscal side. The monetary is raising rates, right? But what have we seen so far? Inflation has not in any way declined, right? So at this point, we are supposed to see, even if it's help from fiscal side, right? Let's see how all of this is playing out, how we want to really maintain price stability. So you're trying to look at how different issues, because we're facing different issues, right? For inflation, agriculture sector is one. Food inflation is over 40%. How are we trying to solve that problem? Most of it is something that the fiscal side can help with. Insecurity, that's a major issue. If we can settle that side, I think we'll be largely good. Most of the harvest, we are around harvest season. We don't even have enough equipment to be able to harvest all of these things. To transport them down is also another thing. So there are a lot of other angles that I think we are not really looking at to combat inflation. Hiking rate is one. But there are other sides to it, and we have to be more holistic in our approach to fighting inflation.
Yes, Clair. I agree with Victoria. I mean, yes, on year-on-year basis, we have seen that inflation continues to rise. But if you look at month-on-month, between May and maybe March and April, we saw a little bit of deceleration of inflation, but that was not quite significant. In June, we saw an increase in inflation again. It just means that like Victoria said, the monetary side is not sufficient, to combat inflation. We need to look at the fiscal, side of things. If you look at, our budget, our expenditure, expenditure for initial expenditure was about 27 trillion. It's quite high, the highest we have seen so far. So, we should be able, the monetary side and the fiscal side should come together to be able to, rein down inflation, for us to actually see inflation come down from where we are right now.
Okay, so that's, I guess, speaking to the player in the BC segment, the business side. So on the authorities, the CBN governor did talk about ways and means, printing money, money supply. What are your thoughts on the I guess money supply side of things, which is what, it's not 100 trillion by now as of the last count or so, and we're still supposed to be giving out cash handouts to folks and so on and so forth. So how do you see that?
I'm happy Clair even mentioned it during her conversation. I believe that current high monetary or money supply is not a monetary phenomenon. And if you look at it, I think it's more from fiscal side. The monetary side, we have seen all of their tools. I think they've even put everything on the table. Yeah. CRL, loan to deposit ratio, liquidity is tight. At least we are both in the market. We've seen how it has panned out so far, right? So if money is coming in, where is it coming from? It has to be from fiscal side. Now, we saw the new supplementary budget, 6 trillion, that is still coming in. Yep. Now, the borrowings that have been happening even in the treasury bills market and all of that, the money is coming in. Most of those monies are going to recurrent, right? And we know how velocity of money works. If you're spending most of it, it moves higher when you're spending it more on consumption than investment, which is basically what we are seeing there. That's why we are of the opinion that we need this, both the fiscal and monetary side to come together and have that handshake. It's very, very important.
Yeah. Yes. Clair, what do you think about?
She had earlier mentioned, some structural issues that we face, especially the agricultural side. Key to the high food inflation that we have seen so far is the fact that we have actually not seen so great amount of harvest from the agricultural side. So I believe that the government needs to, also try and ensure that the fiscal side is also doing its own bit. Look at ensuring that we have infrastructure to be able to, contribute positively to the economy. We're able to solve the security issues too. So I believe that all things, if we were to marry both of them together, if we see, the fiscal side being, contractionary and also the, MPR, all the hikes that it has done so far, if we marry both of them together, I believe we'll be able to have, inflation actually start to come down.
All right, I do want to get to foreign exchange, which also was discussed. So we are presently in the 1,500. We've had a journey from 1,008 to down to 1,001, then back up to 1,500. So how, is it stability or more volatility? Have the Naira found its level? How are you seeing? There's so much to talk about. My word. Yeah. So go ahead.
There is so much to talk about. Yeah. So I'm sure that if I miss out on some things, I'm sure Clair will pick it up. Okay, let's discuss exchange rates, right? Okay, I like to look at exchange rate from 3 perspectives. But first off, I think exchange rate is going to stay within the current window, 1,450, 1,550, best case, that's by December. So exchange rates, let's look at 3 angles. We're looking at remittances, we're looking at capital importation, and let's look at the biggest boy, right, that brings the money to us, that's oil.
Yeah.
if you look at oil production in the first quarter of the year, like in January, we saw oil, doing pretty well. I guess that was why we also saw IMF giving us 3.3% for our growth before they revised it downwards, which I also want to believe is because we are not meeting up with our quota and other reasons, right? So we can see that we are not even producing as much in terms of oil. So that means the FX coming from that angle is already limited, right? And that's the major source. Now, let's move to capital importation. Q1 capital importation numbers, beautiful. But when you take a deeper look into the numbers, you realize that most of the money coming are hot money.
Right.
Yeah.
Most of them were coming for portfolio investments, and the ones that are not coming for portfolio investments are coming for loans, right? Yeah. So that means in a couple of days, right, or highest 364 days, that's for money market, right? These monies will be maturing, and then you now have to start thinking of how you want to pay back this money. Now, remittances. I think I saw a World Bank report on 2023 stating how much remittance we have, which was totally different from what CBN quoted. So that means that most of these remittances are still coming in from the back door. So if you look at the traditional ways that we can get inflows, we are not seeing light at any tunnel. Permit me to use that word, at least for now, right? So we still believe that there will be a lot of volatility until we can at least address any of these issues. Maybe Clair might add more, right? Yeah. But we need to address how to increase FX flow from any of these issues. If it's from remittance, let's work towards it. If it's oil, let's work to end all of the banditry going on, oil thefts, still a lot of issues, and it's something we can work on, right? If it's for capital importation, it's like I said, there's a lot we need to do, but for now, volatility would likely continue.
All right, Claire, what do you think?
Okay, I think Victoria is quite right. Oil production revenue from that side has not been so strong, and that's why we have seen, the government look at desperate ways to get, revenue. But I think everything Victoria just said just boils down to two things: demand and supply. I mean, if you look at the past 2 weeks, the rate has been quite volatile, and this is because there have been a lot of demand, for the summer, for traveling, But we also last week we saw that the CBN came in to, sell, the dollars to BDCs, 20,000 per BDCs, $20,000 per PDC. So I feel like we're still going to see a bit of mixed, volatility and a bit of stability. On one side, we're also expecting, based on the last briefing that the finance minister gave to us, he mentioned that, some inflows are coming from the World Bank, about 2.5 billion now will be coming in. And aside that, we're also looking at, of the bonds, the diaspora bonds, which is going to be, in FX too. So all that hopefully will, support our reserves, improve our naira, and also reduce, this high exchange rate we are seeing. But in H2 2022, I think it's going to be a mix of, stability and volatility.
All right. Now, speaking of FX, and you mentioned some of the other ways in which they're looking for revenues. You both have mentioned the extra budget of 6.2 trillion plus this windfall tax on unrealized gains for the banks. What do you both make of it? Victoria, what do you think?
Okay, so I think it came in quite sudden. I don't know about it, but I think it was quite sudden. There's a lot of unpredictability and uncertainty that I want to believe that investors would have concerning it. And coming at a time where banks are also trying to recapitalize, and at a time where we actually need a lot of foreign inflows into the country, I think this, it might, in a way, not really support those inflows coming in, right? That's what I think about it. But let's see how it goes. But I'm not quite.
I feel like you're being polite. It seems like you're trying to be as polite as possible.
I mean, just to piggyback on what Victoria said, I mean, there are inflows coming in, and, doing this recapitalization exercise, especially when it came, in this year, various analysts, myself, had mentioned that, it's not going to be solely on, domestic investors. We might actually see foreign investors actually want to, take, bids, especially with, banks that are doing IPOs are not really going through the right issues side. So the impact of this this tax is also going to I believe it's going to also affect shareholders, especially in terms of dividend payment, because at the end of the year, banks knows that they have an obligation to fulfill before the end. 30th of December is so banks know that they have to fulfill that obligation, and to meet that cash, to meet that liquidity means that they will need to be taken from somewhere. So I mean, it might likely come from the dividend part, which will likely affect the dividend they will pay out to investors.
And to think that it's actually applying outside the 2023 fiscal year, that's also something else. And they have 5 months to
put it together. What a time to be a bank.
Exactly, and it feels like they have just been playing it. I mean, last year where we saw them mention about unrealized gains, expected that it's going to actually increase with FX. This year they came in with the 0 NOP. Then all of a sudden they said you can't even pay it out of dividends.
Right.
Then now we have this. It feels like they have just been planning it out for a while. So it's just
man. All right. I guess I can ask you both now for your outlook for the rest of this year. How do you see things working out, Victoria, for the second half of 2024?
Okay. For the second half of 2024, let's start with GDP. Our projection for GDP is 3% base case, which is in line, with what we've seen from IMF. 3.1%. A lot of reasons on the back of that.
Oil. Oil production,
and other things. So that aside, inflation is expected to, we think it has peaked, and base year effect is supposed to kick in from July, right? So it's not
we'll see.
But we expect it to average around 32.1%. That's average, but towards December, 29% levels. For exchange rates, my stance on exchange rates, right? We expect a lot of volatility. There's a lot of pressure on that side. We already mentioned. In fact, now we are seeing people going to school. Don't forget, we have people that
demand for school fees.
We have suppliers that are trying to make products that they need to import those products now ahead of December. You know how December can be festivity. So everybody is coming to the market, right? So that's why we believe that there will be a lot of volatility, except we see some huge inflows. Then for World Bank loan, I want to believe it has started coming in already, but 30-day moving average thing. Then I hear of an NMPC swap, so maybe we might see some more money hit our foreign reserve. But for me, I think foreign reserve, right? From that angle, it's like most of the traditional means of really growing the reserve are stifled currently. So if foreign reserve is going to be growing at all, then the monies are probably borrowed money, right? So that's another way to look at it. But so far this year, we are still optimistic. So let's see how it goes.
Expectations are in line with Victoria's. I mean, GDP we see expected to be positive. For the oil side, revenue has not been so strong. But in terms of production, with a lot of oil port being opening, we expect that, and also maintenance. A little bit of production increase from that side, but overall positive GDP end of 2024. Inflation likely to come down. I mean, in line with lower high base from last year. So this is likely to influence inflation numbers too. Foreign exchange. Stability. A bit of stability and volatility with inflows and also demand also influencing that. For the financial markets, for the fixed income market, we still expect that yields are likely to remain high. Supplementary budget, if that is approved, that's also going to mean that the government might want to lean towards either the domestic and the international market. It depends on how that plays out too. For the equities market, we expect it to be, it's still going to close on a positive note, but in terms of H2, what are the drivers, from the banking side, a little bit from, the oil side too. So that's going to influence the equities. But in terms of trend, I still expect that the fixed income market, the investors will focus a lot of of their money in the fixed income market in a bid to take advantage of higher interest rates.
Claire, Ojemen, research analyst, FBNQuest Asset Management, Victoria Njimanze, senior fund analyst, Afrinvest Asset Management. Thank you both for a very informative and engaging discussion on our